Namaste to all. I welcome you all on this another knowledge sharing series through this webinar by your own Accounting Standards Board, where we understand that, of course, accounting is the basics of all preparation of the financial statements, and of course, all taxation. I would talk about income tax, GST, or corporate laws. The basic thing is to the preparation of the financial statement, and for which accounting standards applicability and compliance is the most important. And one of the most important items in the financial statements, in case you are dealing with goods, or I would say even services, is the inventory. And today we will be talking about the nuances of the inventory valuation, both under the AS2 and the Ind AS 2. And for that, we have got our two panelists, two eminent panelists. The first one is CA भावेश जी है ना, मैं थोड़ा सा कहीं मिस ना कर जाऊं.
Yes, sir.
हाँ, भावेश गोंडिया जी. हाँ, sorry.
Yeah.
Bhavesh Gondia ji, having more than 10 years of experience, and he has been contributing regularly to our board, to this board, Accounting Standard Board. He is a faculty on our India certification course and have deliberated a few times through this webinar also on the ASP. You've already done that, and thank you, Bhavesh ji, for taking out time during this season. I would say for everyone, not only the panelist and the moderator, but even the participants, because this time, 31st July, which is for the ITR filing, and tomorrow is the budget day, 23rd. Yes. So just prior to that, so having all of things today, the economic affairs that would also be shared by the Honorable FM in the Parliament. So thank you, Bhavesh Gondia ji, for joining and being a panelist. Yep. Also, we have another panelist, CA Divas Gupta ji, who has got just nearly reaching his decade of practice and experience into, of course, the AS and the Ind AS, regular faculty, and of course has shared a lot of his thoughts during lots of webinars over the years, and always contributing to the Accounting Standard Board. And to moderate these two star panelists, we have got another star moderator. If I talk about, yes, Devaji is also a rank holder in inter and final, so your moderator is also a rank holder in inter and final. So she has done her CA, of course, then of course she's also cleared her Ind AS and BRSR also. She has nearly got more than 7 to 8 years of experience now. Nearly
half a decade, more than half a decade.
Half a decade, more than half a decade. And of course, she's also author of a few Ind AS books, regularly contributing through articles, and have been contributing to the Accounting Standard Board through asking a lot of questions as a moderator. Of course, he is the speaker of more than nearly 75 plus sessions. But when we talk about ASB, asking questions and then counter asking the questions on that becomes very, very important, making the session so interactive. So hoping that this session, of course, would be a grand treat for all the participants who are currently live and who would be also later on viewing it, because this webinar would be available later on also on the same level. So over to you, Chandni, for taking the session forward.
Thank you so much, sir. Thanks to the board for organizing the knowledge sharing session on the nuances of inventory valuation. I think to this date, inventory is one of the items which remains as is in most of the in the balance sheet of most of the companies nowadays. Not just product company, but I think the service companies do also evaluate if they have anything to report as inventory, right? And there are various questions around whether it will be an inventory, whether to be expensed off or to be capitalized as PP. So this particular session is not just by the books. We are going from the practical point of view. We'll discuss the nuances to the practical issues that we are facing related to the inventory valuations. So hopefully the participants and whoever is going to watch this session will utilize this session and will be highly helpful to everyone. So before
Chandni, just one point just came to my mind right now.
Yeah.
Right now, we were talking. You also talked about valuation of inventories in the case of service industry. Now, just take some time and then just think whether can there be any inventories in the service sector, or in the service sector we have to account for on the accrual basis the unbilled revenue, or there could be an inventory also of the service sector. Just a point to think and deliberate whenever you feel appropriate about that.
Definitely, sir. I think this point also will be covered in one of our questions, because there are various startups which are doing such dynamic work these days. They are providing services, but they do also have inventory online. There is, because we are in the world of edtech, fintech companies. So there are various items that we need to deliberate on, whether it will be inventory or to be, capitalized. So I think some of this will be covered in our questions, but definitely we'll be taking up questions from the participants as well and discuss on this particular question as well. So, yes. So before we get into the discussion, I think the first and foremost important question that we need to address is what we are going to talk about. We are talking about the inventory. So what is inventory really, and how the definition is different in different gaps? Because as we speak, we have AS in motion, we have Ind AS in motion, we have ICDS, right? So to Divas, I would like to hear from you what really is inventory and how the definitions are different.
Yeah. Good evening, everyone. First of all, thanks a lot to CA Pramod Jain sir for setting the context and for the opening remarks. Thank you, Chandni, for that question. So basically, first of all, what does really an inventory means? Let me take you through the Ind AS definition first, and then from that we can draw parallels to what accounting standard ICDS and IAS means. So inventory, if we see, inventory are assets which are held for sale in the ordinary course of business, which can be regarded as the finished goods, first of all. Then the second bullet point of the definition, as per Ind AS, it says that, or it is held in the process of production of such sale, which is definitely the work in progress, because it is held in the production process. And last bullet, it says that it is held in the form of a material or supplies to be consumed in the production process or in the rendering of the services. Now it again connects back to the same thought that Pramod Jain sir also have given to us. So for whatever raw material, packing material that a company is having, either using that it is making some products and selling it, or for example, I can talk about a company which is in a shipping line, right? For that shipping line, the raw material will be the fuel that the company is using, right? Although the company is in the service sector, but the inventory for that will be the fuel, right? Because using that fuel, the ship will operate, and basis that it will be consumed in the rendering of services, right? So with that, I can say that finished goods, I can say WIP, work in progress, I can say all the raw material, packing material, and any other consumables that are held for the provision of services or for making of the FGs. So this is on the definition of inventories. Now, if I come to accounting standard AS2, so the definition is not very much different. It is very much similar. Even ICDS as well as IAS, which is the International Accounting Standard, all of them carry the same definition. But there are two notable differences which I would like to bring here in the discussion. One is that in Ind AS 2, there is a separate introduction of broker traded commodities, right? Some of the broker houses deal in certain commodities with a view to sell them in future, right? So the idea for brokers is to earn the short-term margins because of the pricing fluctuations. Now, this specific part was not covered in Accounting Standard 2, which Ind AS 2 came in. And the reason why Ind AS 2 came in with this is because all of us know, and we will be discussing it today further, that inventories are generally valued at cost or NRV, whichever is lower. But the idea to bring this exception from inventories Ind AS 2 is because these inventories are allowed to be valued at fair value, less cost to sell, which is a separate thing which we will discuss later on. But this is one notable difference between Accounting Standard 2 and Ind AS 2 if we talk about the inventory scope and inventory definition. And the second thing is actually the spare parts, equipment, standby equipments, which were earlier part of Accounting Standard 2. It clearly specifies that under which cases spare parts, standby equipments will be covered under Accounting Standard 2. But Ind AS 2 does not have that explanation. Rather, Ind AS 16, which is property, plant and equipment, deals with this situation, and it says that if any spare part or if any standby equipment is not fulfilling the definition of PP, then it can go to Ind AS 2, which is inventories. So what I'm trying to say is that spare parts and standby equipment can become inventory by virtue of Ind AS 16, not by virtue of Ind AS 2. However, in Accounting Standard 2, the spare parts became inventory by virtue of Accounting Standard 2 itself. So this is what I would say in the initial phase about the inventory, how we deal in both the standards. Yeah. Thank you, Chan.
Thank you, Divyaji. I'm just again going into the service. You rightly said, in case of say transport, you are having fuel as an inventory. Let me take a case of a chartered accountant firm, or an advocate firm, or a company secretary firm.
Sure, sir.
So who are following the accrual system of accounting. So the services partly rendered, that cannot be as an inventory. Of course, for that you will have to have an unbilled revenue. So their inventory would be what I would say, if they have to issue reports, the paper which they are having, or just a loud thing, what I think, just right now.
Right.
Because few of professional chartered accountants or advocates, they're following accrual system of accounting. So their inventory would be those givable file folders or paper like that. But the services rendered for that, they have to bill unbilled revenue. Bhaveshji or Deveshji, if you concur with that view, kindly tell.
Sure.
Yeah, but sir, in that, let me add one more thing. Like we have a chartered accountant being as an employee in the organization, in the CA firm, and you have sent them for an audit. The audit is not yet completed, but at least those people have rendered the service to you. Can I consider that portion of a salary being as a lying as a stock?
No, again, because stock has to be tangible. In my view, inventories has to be tangible.
Okay.
So that is a percentage of work which I have completed.
Right.
So for that, I should bill that unbilled revenue.
Okay.
In my view, because certain percentage, it is not about only his travel commutation or his time or his salary, but the percentage which he has completed, for that I have to bill an unbilled revenue. So services portion, which is not tangible, may not be taken as an inventory. But even in the service sector, so suppose one is giving an AMC, or just like Devas, he said about freight carrier and all others, so fuel. So those tangible goods could be inventory even in the accrual system. Cash system, they will be expenses. Just wanted to bring to the knowledge of all the participants today.
Right.
Thank you. Sorry for interrupting in between.
No, thank you, sir. Thank you very much.
Thank you so much. All these questions only add to the productivity of the whole discussion. So thank you so much for bringing that up. I'm sure a lot of participants would have benefited from that. Moving on to the next question, I would like to request Bhavesh sir to take up this. So if we have a company who has imported some goods against an LC, right? And they've imported 2 days ago the close of balance sheet on 20th, 1 month ago, 20th February 2024, and accounted a payable basis, say a Forex rate of 82 per dollar.
Okay.
However, on the reporting date, on the balance sheet date of 31st March, the rate increased from 82 to 84 per dollar. The
Okay.
goods are still lying in the warehouse. So this fluctuation of 2 rupee per dollar, can this be adjusted in the cost of inventory instead of P&L? What would be the treatment in this case from AS point of view and from India's point of view?
Yeah. Yeah. First of all, thank you, Pramod sir, for a nice opening remarks, as well as thanks to the ASB also for giving me an opportunity to give certain insights about the inventory. As ma'am has drafted the question, it is coming with the numbers, no? So as and when the numbers are coming, no, I need to use the board to place the number. That is a system generally I follow while taking session under the Ind-AS course also. So let me take a help of a board and note down certain points which you have told. Yeah, ma'am, this slide is visible?
Yes, sir.
Yeah. Yeah, ma'am, I hope you told about like on 20th of February, the rate was INR 82 per dollar.
That's right.
And we have got goods by way of inventory.
Right. We have imported against an LC.
Yes,
So
we have
a PV.
imported. Okay.
Yeah.
Then on a year ending, that is on 31st of March,
Right.
24, the rate has increased from 82 to 84. So that 2 rupees, can I say my liability has increased by 2 rupees. So this is a loss. Question before us is that, can I add this loss or adjust in the cost of the inventory or not? Number one, that is, can I add it to the cost to inventory, or should I charge it to the profit and loss? This is a question before us. Now, answering to this question, I would like to take a reference of the foreign exchange standard also, where they have classified the a translation of items into two parts. One is monetary items and other is the non-monetary items. So coming towards the monetary items, you have debtors, creditors, that we may adjust it. And whatever the exchange gain or a loss is coming, that we are supposed to transfer it to the P&L account. Now, in that foreign exchange, we have been told that inventory would be classified as a non-monetary item. So when it is a non-monetary item and any exchange gain or a loss is arising, particularly I'm talking about an inventory. Then we cannot adjust it to the cost of the inventories, and compulsorily we are supposed to charge to the profit and loss account. So that 2 rupees, we will transfer it to the P&L as an exchange loss, and it will not be adjusted to the cost of inventory. But along in that question, I would like to add one more part about that. If it would have been a long-term monetary asset, because see, inventory is a non-monetary item, short-term in nature. But when you have a long-term monetary item and there is any exchange loss or a gain is arising, then you have an option to adjust under the accounting standard to the cost of the asset instead of charging to the P&L account. So particularly for an inventory, we are supposed to take it to the P&L account, this loss of rupees 2, and not to adjust against the cost of the inventory. Over to you, ma'am.
Thank you so much, sir. So basically, here we are saying
Yeah, again, sorry. I have another question to hear, Bhaveshji.
Yes, sir.
This may be a case where that imported inventory is still in my, I acquired that inventory, it is there in the closing stock.
Okay.
what if that inventory which we imported was sold and there was nothing outstanding? However, the payment due to the seller, the trade payable, is due.
Yes.
Because once I have acquired the inventory, whether I sell it or keep it as my inventory, will that be an important point, or it is about the payment which is to be made from the seller, or the trade payables which I have to pay?
See, answer to your first point, that you are telling that the payment is not yet made, but the inventory is sold. See, when payment is not made and inventory is sold, there is no question of adjusting the cost of inventory. It would go to the P&L only, because we don't have any option on. Once that inventory itself is not there in your books of accounts, there is no question of adjusting the exchange loss or a gain to the inventory, and we are supposed to transfer it to the P&L only. Here the question is coming, I hope, because inventory is there as well as a payment is also pending. So question before us is coming, that where to adjust that loss, P&L debit, or I should add it to the cost of the inventory. So either in both the case, referring in line with the foreign exchange also, this would be a part of non-monetary item. If it would have been a long-term monetary asset, like a fixed asset, tangible asset, then there is an option to adjust the cost of the asset. But under the inventory, based on my view, it is transferred to the P&L account.
No, thank you, Bhavesh. My only thing was whether it would be based on inventory or the trade payable. Because what is outstanding in my books, if I say inventory on my balance sheet asset side and trade payables on the liability side. So if I bring both to market, then the impact would be, I don't know what, for the foreign exchange fluctuation which I book to PL. I don't know, just giving a thought that may not be.
Just to add, can I add one point, sir? With your
yeah.
No, sir. So, sir, what you have asked is rightly apt, because the decision to take it to P&L will depend on whether the trade payable is outstanding or not. It is not because of the inventory. Whether inventory is held or is it sold, it is agnostic of that. We will have to take it to P&L if trade payable is there. So it depends on the trade payable existence in case of items like inventory.
Right.
Thank you.
Yeah, right. So basically, just to summarize, the decision of Forex fluctuation adjustment is, as Bhavesh sir mentioned, on the non-monetary and monetary classification. Since the inventory is a non-monetary item, there is no point of adjusting the Forex. However, since trade payable, which is still outstanding at the reporting date, and it's a monetary item, that is why we have to reinstate the balance and adjust the Forex adjustment to the P&L. So that is how the entire treatment has gone. Thank you so much, Bhavesh sir, Divas sir, and Pramod sir, for discussing the point and clarifying. Now, I would come back to Divas sir with a very practical question, I think, because this is not something which we hear from everyone, but this is a very industry specific question. So nowadays, when we roam around on the road, we see every day that there are various brand boards and hoardings and billboards, right, on various, it's everywhere. So let's take an example about the hotel chains. For example, OYO, Fab Hotels, right? There are various chains, and we see their boards on the properties, right? So now we need to understand how the hotel chain has to account for these boards. Will these be PT, or they will be part of inventory, or they should be expensed off? So we want to understand that from your lens.
Sure. So maybe I can first give what is the industry commercials behind these kind of arrangements, because essentially the brands that we are calling out, let's say OYO or Fab Hotels, are generally the brand owners, right? Because that is where the brand rests with them. Now, typically what my understanding and what my experience is that there are separate third-party agencies who are actually maintaining these networks of the billboards, right? So they are responsible for getting the billboards commissioned at a particular place. They will be responsible for selling that spaces to the brands such as Oyo and Fab Hotels, and then they will purchase or not purchase. I mean, they will rent it out those spaces, and Oyo and Fab Hotel will end up giving rents as a periodic cost to the to that agency who is owning those billboards. So in that case, if that is happening, then it is just a period cost for the brand owners, and they will charge it to the P&L. So that is first situation. Now, second situation can be where, let's say, these billboards are commissioned and owned by the brand owners themselves, right? So in that case, since we have just now gone and saw how the inventory works, so if we try to fit these into the inventory definition, then definitely it will not fall into, because it's not going to be consumed in the provision of service, right? It's just a display board that is helping the brand for the advertisement purpose. That is point number one. Point number two, neither it is finished goods, neither it is work in progress, neither it is raw material or packing material. So with that, the only standard that is left to classify this is the Ind AS 16 PPE. Now, if we check the definition over there, so it says that for administrative or for selling purposes, if there are any assets that are being held and are expected to be used for more than 1 year, right, which is in the current case. So hence, in my knowledge, it should be classified to the Ind AS 16, which is property, plant and equipment, and should not be dealt in Ind AS 2, which is inventories. So yeah, I mean, these are the two situations I can think of. One, if agency operates it and owns it, and second, if the brand itself operates and owns it,
Right.
and the accounting treatment respectively. Yeah.
Right. So basically, in no case it will be classified as an inventory. The question will be
Right.
either it will be an expense, because if the third party agency is involved and they're just charging you a rent or a
Rent, yes.
commission, in that case, then it will be
Right.
an expense. If the board is the hotels itself, then it will
Right.
be a PPE, because it's being used for
Right.
more than 1 year, and it's a tangible asset, fits in the
Right.
PPE definition.
Right. Actually,
Pramod,
practically, sorry.
right.
Sorry,
No,
go ahead.
please continue.
Yeah. No, what I was saying is practically I've seen at least 90 to 95% of the contracts comes in the agency relationship, wherein a separate agency is maintaining and owning those billboards. And let's say they will enter into an agreement for 11 months, 12 months for the brand to display their signs on the board. That's how it happens.
Right.
So in that case, it will be a rent cost. Yeah.
Right. So basically, these two cases can also, I think, parallelly exist, because if we are talking about the billboards and hoardings that we see across the highways, those huge giant billboards, those are from the agencies and the third party agency, the first point that you have covered. But if we talk about the small boards, say, for example, it's a Oyo property and there's a Oyo board on that in front of that property, that particular board would be probably PPE, because that they can,
Yes.
move from one property to the
To
other
another
property as well.
property. That is true.
Right. Okay. So, Pramod sir, if you have anything to add on this particular discussion.
No, fine. Thank you.
Thank you so much, sir. So, thank you so much, Divas sir, for answering this question in a very practical manner, I would say, discussing both the scenarios. Now, I would like to move on to Bhavesh sir. So this is a question for the alco-bev industry, where they are producing, say, wines, whiskeys, and various other spirits which require years of aging. Right. In this case, inventory of such products, whether should be classified as inventory, and if yes, then what would be the cost of, the cost that has been incurred to treat that aging process? For example, the storage cost, because it takes a long period of time to age that.
Yes, ma'am. Like as you have told about this alco-bev companies, where a storage cost, because a majority part of manufacturing that particular products by those companies would be a much of storage in nature. As and when much storage is done, that product would be a better. So our question before us that how to treat that storage cost, whether it should be a part of cost of inventory or should I charge it to my P&L as an indirect expense. So for that, inventory has given certain exclusion that this many cost will not form part of cost of inventory, and you are supposed to treat it as a part of indirect cost. Like for example, let me just like there are 3-4 type of cost. When my screen is visible, no, the slide.
Yes, sir.
Yeah, there are certain cost which are being excluded from the valuation of the cost of inventory. Like we have abnormal amount of waste material, labor, and other products. Your point is also coming here like a storage cost. What to be done with the storage cost? That storage cost will be excluded, provided unless necessary to the production process before the further production process stage. That means if you need to transfer the material from one process to another process, for that time, if you are storing that particular goods at some location, then that storage cost would not form part of exclusion. So it will be excluded provided your inventory is ready and you are waiting for the sale to happen. For that period of time, if you are storing at certain place, then we can say it is not a part of integral process. The goods are ready. So that storage cost you may exclude it. But now for your question, for your particular industry, as you are told about the alcobev companies, like if they are producing whiskey, spirits, or like other products, then we know that it needs a storage for a longer period of time. So now a question before us will come that whether that storage, can I treat it as a part of integral process to manufacture or to reach to the finished goods? If answer to that question is yes, mostly yes for this kind of industry, because we need that level or that much amount of time in order to make that product sellable condition with a better price. So I would treat for particular this industry that storage cost would become integral part and integral cost in order to make that finished goods ready. Hence this storage cost, I should add it to the cost of inventory as a part of finished goods.
Thank you so much, sir. So just to summarize this, basically we're saying the alcobev industry, which requires their inventory to be stored for a very long time to be able to make it saleable, right? The storage cost will be a part of the cost of inventory because that is a production, that is part of the production process. The storage is a part of the production process. Otherwise, they won't be able to make it into a saleable condition, right?
Yes.
So that is why the storage cost needs to be included in the cost of inventory.
Yes. But standard is specifically excluded. We are including because for this reason.
Absolutely. Thank you so much, sir, for answering that question. Now, sticking to the beverage industry, I have another question. The companies which sell products in glass bottles. So, for example, we all remember sipping up on the Pepsi glass bottles in old times, right? So, for instance, the company collects those glass bottles from the roadsides and we use them for the next batch for a fresh inventory. How those glass bottles should be treated in the books of accounts?
Yes, ma'am. Like the glass bottles, that examples that you have given about the Pepsi and the other drinks, soft drinks which we have, because see now a question is that those glass bottles are reused for more than one time. So it is available for use for more than one time. So I'll be using for like 4 to 5 times. I'll be using that particular glass bottle, assume 4 to 5 times. So this would become your property, plant and equipment, and it will not be considered as a part of inventory. Because I'm not selling the bottle. I am reusing the bottles for the second time when I want to deliver that drinks to the consumer. So that glass bottle, those empty bottles would form part of your property, plant and equipment, and you may claim depreciation, and that depreciation will become part of your cost of the production. That is the way the glass bottle we may treat it in our books of accounts.
In that case, sir, I think there would be a huge loss as well, because not necessarily that if 100 bottles goes in market, then 100 bottles come back to the company, right? There might be a lot of loss in transit or in the market itself. In that case, I mean, how should they adjust?
Yeah, that is also a possibility, but at those time also, the company used to take a deposits before they deliver the glass bottles. So that deposit was being collected against those glass bottles only. So that company used to take care to safeguard those bottles, that deposit are also being taken. So more or less would be an adjustment in such a way that it would not be spoiled or damaged or gets deteriorated.
And it won't be a hit to the P&L.
Yes.
Thank you so much, sir, for answering those two questions. Now, I would like to come back to Divas, sir. So, I have a question related to the rent cost. Should the rent cost incurred during scheduled maintenance shutdowns be recognized as part of inventory for the manufacturing entity specifically? And what about the rent cost during the unplanned plant shutdowns or the labor strikes, for example?
Right. So, yeah, thanks for this question. So basically, the way I will deal with this question is I will rather talk about the entire, indirect overheads, right? The fixed overheads that comes. So what happens if you see the cost of an inventory? The way it is defined is it includes the direct material, direct labor, variable overheads, and indirect overheads, or let's say fixed overheads, I can say. Right. So fixed overheads of a factory can include a lot of things, which again the standard has tried to define. Some of them are, let's say, depreciation on the plant and machinery, right? Even all the factory related cost, right? Factory administration related costs, whatever are the overheads, they can come into that. So, and even rent being part of that. So I'm saying whatever cost it takes, which is not variable in relation to the production, is part of this discussion, which we are having now. Rent being one of them. Now, the way standard says is, you have to first of all see that what is your normal operating, levels. Let's say the capacity of a plant is something, but out of that capacity, basis the scheduled maintenance or basis some of the time out that is already scheduled or planned, you will be able to achieve, let's say, 80% of your installed capacity. I'm assuming, let's say, 1 lakh is the installed capacity, 1 lakh units, and 80,000 is the basically normal operating levels, which the company does. And it is also evident from the budgets, from the forecast, from the plans of the company for the full year. Now, basis this activity of 80,000, the company has planned the fixed overheads also for that plant, right? Which includes rent again. Now, if let's say, and basis this activity, the company, arrives at a rate of absorption of, let's say, 2 rupees per hour. I'm relating it to per hour because mostly companies defines the absorption rate on per hour basis, right? Now, what happens? Let's say there are 2 different situations in this. During the year, the company achieves 80,000 units, and whatever it forecasted, the actual also came onto that. So there is no issue, there is no problem the allocation of the fixed overheads has happened in a proper manner to the inventory. Okay. Now, which in case, let's say, because 20,000 units are lower produced than the installed capacity because of the scheduled maintenance, which is understood. Now, the second case can be the production was lower than the estimated one, which is, let's say, 60,000 or 50,000. In that case, the allocation rate will increase, right, of the fixed overheads, because you are keeping your fixed overheads cost constant and you are absorbing it on the lower number of units, right? So in that case, your absorption rate will increase. And I will come to that. What are the reasons for such decrease? See, one reason is that there is no demand of the product, right? Or second is there can be unplanned situations such as labor strike, which is in the question also. There can be, some of the rough patch. There can be some seasonal related issues that the business is going through. So the moment the absorption rate increases, right? So the standard says that till the time it's a permanent decrease in the normal capacity, you need not allocate a higher amount to the inventory. So the standard says that you still follow the normal allocation, which is rupees 2 per hour, which was basis the 80,000 units. And you need not increase basis the 50,000 units, which is what the standard says. Because it says that still the normal level of production, 2 rupees per hour is the still rate. You cannot allocate a higher amount to the inventory just because you have a lower demand, just because you have something unplanned in between, right? So you can't do that. However, in case the actual production is higher, right? That can also be the case. So in that case, the allocation rate of overheads will go down, right? Because again, you are incurring the same level of fixed overheads and your production is high. That will lead to lower absorption rates. So now in this case, standard says that you can lower down the allocations of those overheads to inventory. So on the higher side, if the allocation rate becomes higher, the standard says that you need not take the higher rate, just take the regular rate. And in case of lower absorption rate, which is in the case of higher productions, so you need to just stay, so you can actually take the lower rate. The reason is why standard is asking in the second case to adopt a lower absorption rate is because the standard is apprehensive of the fact that, ultimately you have to value it at cost, right? In this case, if you still take a 2 rupees per rate and you ignore the lower absorption rate, then you might end up valuing your inventory at a higher cost, but which is not the case because your absorption rate would have dropped to, let's say, 1.5 rupees per hour, right? So you need to take 1.5 rupees per hour and you have to actualize this. Now coming on to the first case where, the production is achieved lower, okay? In that case, since the overhead rate has increased, but the standard is not allowing us to take that allocation to inventory. So what we have to do, we have to take it to P&L. So we have to present those unallocated overheads as part of the P&L, which will be reflective of the fact that you have operated at lower than the capacity, at lower than your normative levels, and hence you have to take it to P&L. I hope with this question, the entire logic of overhead absorption, under absorption and over absorption, both are clear.
Right. Thank you so much, sir. So basically, the participants who are listening, related to the overheads, we have to analyze the normal capacity, the actual production, and we have to compare if the actual production is lower than the normal capacity. In that case, you would have a surplus fixed cost which has not been absorbed, which
Right.
will go to P&L. But if the actual production is higher than the normal capacity, in that case, the entire cost will be absorbed by the inventory itself.
Right.
Thank you so much, sir, for answering the question. Now moving on to the next question, coming to you, Bhavesh, sir. Again, industry-specific question related to the brokers. There's a share broking company which is dealing in sale and purchase of shares for its own account, and therefore is having an inventory of shares which purchased by it for the trading purposes. The company is covered under the phase 2 of Ind AS roadmap. What will be the accounting treatment of such shares which are held as stock in trade in accordance with Ind AS?
Okay. Yeah, in the first question only, sir has also told about the certain changes in relation to the share broking firm who are holding their securities in form of stock in trade. So there is an exception is also available. Sir has also told in the first question. But along with that, let me put down a particular point for that particular scope that is there. That we have like a commodity broker or a trader who measures their inventory, they are supposed to measure it at fair value less cost to sell. So like a applicability of cost or a market value would not arise to those commodity brokers or traders. But one more thing I will tell you, that this is just an exception to the measurement provision that you are supposed to follow for the valuation of those securities held by the commodity broker or share traders for this particular point. But other than that, like a disclosure provision and everything, those are being followed in line with Ind AS 2 only. So Ind AS 2 has specifically excluded or provided an exception in order to overcome that fluctuations which are happening to those particular securities and the trade, fair value less cost to sell. And that fair value less cost to sell, ma'am, one more thing I would like to add, that it would not be an entity specific. Like whenever you say, like in the inventory, we have a word called as a net realizable value. That net realizable value will differ entity to entity, because that we are determining on the basis of considering a particular entity. And whenever you say fair value less cost to sell, it would be addressing not an entity specific, it would follow a market specific parameters. So coming towards your point about the treatment of those stock held in trade would be done with fair value less cost to sell, and cost or market value, that concept that we have for normal inventory, that would not apply to the commodity broker or a traders. Over to you, ma'am.
Thank you so much, sir, for asking the questions. Sticking to the broking company, what if the broking company that has inventory of listed shares or securities as at 31st March values it at the closing price on the stock market in accordance with ICDS 8, which is lower than the cost? Therefore, the company records a loss on 31st March. Whether the amount of such loss is an allowable deduction?
Yeah, now you referred to the ICDS 8 for that. In context to that, whatever the loss which are coming to the broking firm, whether that would be considered as an allowable deduction or not. A valuation measurement part is being given by the standard. Considering this ICDS also, over there also this kind of loss would be considered and it is allowed by way of an deduction, considering the provision of your ICDS 8 that we have.
Thank you so much, sir, for answering the question. Moving on to the next question, coming to Divas, sir. There are various FRRB observations on financial statements wherein the accounting policy for inventory quotes valued at lower of cost and fair value. Right? It's, most of us know that it's cost and NRV, the lower of these two values. However, people still are using the term fair value instead of NRV. Why do you think this confusion is being caused, and what is the primary difference between these two values, fair value and NRV?
Sure. Thanks for the question. So if we see in the entire Ind AS regime, there are a lot of standards that use fair value,
Right.
And hence there might be a confusion that, even the NRV is actually the fair value, but which is not. So as Bhavesh sir also tried to say that, while in the previous question, that fair value is something from the market entity specific, and NRV is something which is the entity specific. Now let me, explain that. So if we see Ind AS 2, okay, it talks about three types of measurements. One is cost, second is NRV, third is fair value. Let me bring parallels in all the three, so that all of us know that what are the reasonable differences that we can think of in all the three. So I think cost is pretty clear to all of us, right? Cost, we don't struggle too much, because cost is actually what we are spending, which can be in the form of the purchase cost, some of the import duties which are not allowed as the credit, right? Some of the input taxes which are not allowed as credit. All the cost that is incurred to bring those inventories to the present condition and location. This is again given by Ind AS 2 only in the definition. So all those costs you can think of that are directly attributable to that inventory that we have actually spent is part of the cost. And just before that, we were talking about the direct labor, indirect overheads, variable overheads, fixed overheads. So all those will be part of the cost definition. Now let's come to NRV, which is net realizable value. Why it is important? Because inventories are valued at cost or NRV, whichever is lower. Okay, so we need to understand what is NRV. Now NRV, the way definition it flows is net realizable value is the estimated selling price in the ordinary course of the business, less the estimated cost of completion and the estimated cost necessary to make the sale. Now let us hold on to this. So NRV is governed by the entity specific factors for which we are trying to value the inventory. For example, the entity might have certain outstanding customer contracts. Basis that, entity can understand that the inventory that the entity is holding is sellable, let's say at 100 rupees. Okay. Now that becomes the starting point of NRV, because this contract is specific to the entity which is in question, right? So using that reference point, the NRV can be estimated. From that 100 rupees, we will be reducing the estimated cost of selling, which is, let's say, in all the efforts that we are doing, let's say we are end up spending 5 rupees as commission, right? For getting that sales, 5 rupees is commission. So ultimately my NRV becomes 95. Okay, understood. And there is no estimated cost of completion because this is already a finished goods. So I am assuming 95 rupees is my NRV. Now let's come to fair value, right? Now fair value, if you see, the Ind AS 2 refers to Ind AS 113 for elaborating on fair value as a definition. Now Ind AS 113, it says that fair value is something that is based on the exit price, and it is something to do with the third party market participants, right? It is not that what value of contract that you are holding. It is that, let's say today, if this inventory, what is the right value that the market participants will take on this inventory? Now the way to calculate it is again a different way that has been prescribed there. Now I'm just extending the same example of that 95 rupees as NRV. Now let's say the market value of that inventory becomes 110. It can be the case. So the fair value becomes 110 because in market, the people are selling and purchasing it at 110, which are the third party market participants, right? So in a way, that is called as fair value, right? And from that, we will reduce the cost to sell, which is fair value less cost to sell is 5 rupees. Again, the commission I'm taking the same. So 105 becomes the fair value less cost to sell. So basically, just to sum up the entire discussion, there is a big difference between how NRV is looked at and how fair value is looked at. Fair value is not dependent on the that entity have? It is really dependent on how market participants would want to value that inventory. On the other hand, NRV is dependent on what value is being derived by the entity specific business. Okay, so this is what about I have to say. And yes, there are a lot of observations. For example, FRRB has also noted that in some of the accounting policies of the India's compliant companies still carry this line valued at lower of cost and fair value, which is wrong. Absolutely. It should be valued at lower of cost and NRV. So that is the right, disclosure is what I feel. And fair value less cost to sell, as Sir has also mentioned, is applicable only in case of broker traded commodities. Yeah.
Absolutely. Thank you so much, sir, for answering that question.
Ma'am, just 10 seconds. I would like to just make an addition to the sir's point. Like, sir, can I take up like a NRV would be a price that an entity decides. That an entity decides to sell, even if the market price is higher or lower. Like if I am producing 1 unit and my cost price is 8, and in the market, this product can be sold at 10. This product can be sold at 10. Now, if the entity makes an agreement with another party to sell at a price other than 10, that will become an NRV. An entity decides to sell other than 10. It might be lower or it might be higher. Can I say that would become an NRV for that particular entity, and that 10 rupees, the 10 rupees which I have fixed will become an fair value less cost to sell.
Sir, so this 10 rupees is what exactly? 10 rupees is
10 rupees is a selling price in the open market.
10 rupees is selling price in the open market. Sure.
In the open market.
So that is my fair value. That
becomes a fair value less cost to sell. So NRV, like, can I say that the entity decides to sell their particular product other than 10 rupees would become their NRV, either it is higher or a lower.
Perfect. It will become the NRV, sir. Yes. Ultimately, see, as an evidence, the entity has to prove that there is a contract in place, that anything higher or lower is evidenced by the contract, because it's the estimated selling price for the entity. So that will become NRV.
So are we saying that NRV is primarily driven from the fair value?
No. NRV is something which entity is been selling historically and is committed to sell in future, right? But fair value is something that, let's say, a market participants would be willing to enter or willing to sell at a, let's say, in a orderly transaction. So that is what a fair value will be. Now, okay, let me tell you one more interesting thought. So all of us have heard about India's 103, right, which is the business combination, right? In India's 103 business combination, essentially it says that all the identifiable assets and liabilities has to be valued at fair value. Now, if I take over any business, right, so in that case, I will take over inventory also. Now the question comes whether inventory will be taken at the cost of that the target company, or it will be taken at the NRV, or it will be taken at the fair value. The standard says it will be taken at the fair value, right? Now, most of the cases, what we have seen practically, although the carrying value of inventory in the target company's balance sheet is, let's say, 100 rupees, right? So most of us think that, while taking over, it should be 100 rupees in my balance sheet also, the acquiring company. But what we have seen, because of this fair value provision, the value increases. It can be 120 rupees or it can be lower also, because that fair value is not dependent on what target company and acquiring company thinks of. It is really dependent on third-party market participants who are willing to do those transactions in an orderly basis, right? So that is really what I'm trying to say is the fair value of inventory is also required to be calculated in those situations, which can be very much different.
So, okay, just to summarize on the NRV, from the NRV point of view, are we saying that NRV, basically for NRV, we need an estimated selling price. Now, that
Right.
estimated selling price may come from a contract that the company already has in place, or if the contract is not in place already, there
Right.
should be an active market where the company has been doing transactions and there is a past trend, right? What if there is no active market, there is no contract in place? Then in that case, how the person should determine the selling price?
Got it. See again, if I say in case of fair value, Ind AS 113, okay, the concept of active market exists. Now, what do we mean by active market? First of all, active market as per Ind AS 113, it specifies that a market in which that asset or liability is being traded with sufficient volume and the prices are also available on a reasonable basis at any point of time, right? That is what the active market is. And that is also what we also understand from a layman's term. Now, again, this active market as a concept is applicable in fair value, right? Because see, ultimately in fair value, the market participants will actually value the inventory in a market which is a principal or most advantageous market, and they will also assume the highest and best use of that asset. Again, I'm referring to the provisions of Ind AS 113, right? I mean, they will not pay any attention to what entity is expecting from the usage. So they will think that what market participants would have assumed from the highest and best use in the principal market, or in its absence, most advantageous market, right? So, I mean, those provisions are totally separate. And in that case, also it defines if active market is not there, then what should be the next step. So I'm saying the possibility of NRV from an active market is actually ruled out. In case contract is not existing, definitely there are other things that the entity can resort to. For example, let me talk about lot of products in the market come on MRP basis, right? Now there is a pricing, let's say, mechanism on MRP. There is a retailer margin. There is a, there are the margins. There are gross margins that are given on those products, right? So maybe an entity can understand that, at a inventory level, they will carry what are the different MRPs, and against those MRPs, they already know that, let's say, X% is the margin that I offer. So they can reduce that to arrive at the estimated selling price that the company is offering. Again, I'm saying the company is offering, not the market participants. So that can be situation number one. Situation number two can be in case the products are not MRP based, then what has been your historical average selling prices, right? Maybe that can be of help if there is no future customer contract for the selling price estimation, right? So I think these are some of the things that can be taken into account while we say that we are determining NRV, but contract is not available.
Right. So, in nutshell, we are saying if the estimated selling price is not actively available, maybe it can be a case of a newly incorporated company or any other, impracticality that is being faced by the company. In that case, they must resort to the MRPs of a similar product in the market, or if the MRP of same product is available in the market.
Yeah.
If it's an already incorporated company, they can definitely resort to their past trends of the selling prices.
Right.
And these can be the alternative approaches for determining the estimated selling price.
Right. Sorry, only just one point. They can refer to the MRP minus the margins that they're going to offer, because ultimately MRP is not NRV. Right. MRP minus margins will be the starting point of NRV.
Right. Basically, they'll have to adjust the MRP to their own
account for the margins, actually.
Right.
Yeah. For that also, we have that retail method is there. If you are not able to determine the standard cost of any product, due to a large quantity of products that you have, then you may refer it to the retail method also in order to bring to the cost of the inventory, taking up the MRP and deducting the gross margin percentage in that.
Right. Absolutely. Thanks for adding that, sir. Now, moving on to the next question, I think in the interest of time also, we need to accelerate this a little bit. To Bhavesh, sir, this question is, In case of seasonal items, when a season ends, the manufacturer also starts offering heavy discounts, right? And when sellers take the advantage and procure items, the price of the same product will vary compared to the price it was bought at the beginning of the season. Right? For example, we'll take an example here. There's a garment seller who is selling coats during winters, right? But the weather doesn't get as cold as was expected, which results in lower demand for coats. Like, for example, we have been seeing the climate since past 2-3 years. It has been extremely unpredictable, right? So therefore, the seller will have to store all that inventory till the next season, right, which can damage the product. The quality of the product can deteriorate or make them obsolete as newer designs may be introduced in the market. So in such a case, how should the dealer deal with the changing value of inventory?
Like, see, like this kind of cases, like every particular type of industry would not be addressed by the standard. A standard would be talking in terms of, like, if you hold any inventory, which are no, like we have finished goods, WIP, and raw material. So, like, if any manufacturer of a mobile phones, then they have a raw material of like plastic, keypads, glass, and everything. So for other organization, they will have different type of raw material. So they say raw material at cost price, WIP at so and so, finished goods like cost or NRV, whichever is lower. So we need to follow that particular a theory to approach all the finished goods, which every industry or a different industry those people are having. But here it would be a particular case, as you are telling about, the price would get varied, seasons gets over, so they need to offer a discount. The other competitors would take a benefit of that. But we will follow the same methodology that we have for the finished goods for them for the valuation of inventory. But along with that, how to deal with the value. So for that, like we may consider following a weighted average method for this in order to cope up with the cost. Because as you will say, the designs would get outdated, something would get obsolete in nature, then it would be somewhat difficult to sell during the season, even in the next season also. So for following the valuation under coming, because now we will not treat it as a specific items, but we will take it in a group, and we may follow the weighted average method to value those inventory, but for reading with the provision of the finished goods that we have cost or a NRV. That is a way, would be the better way to approach for this kind of seasonal items that we have.
Basically, the NRV will showcase the reduction in the value drastically, because obviously the
Yes.
estimated selling price would be much, much lower than the cost for the next season.
Yes.
So that will be treated same as any other inventory and will value the inventory at lower of cost and NRV.
Yes. Yes. Yes.
All right. Thank you. Thank you so much, sir. Moving on to the next question. We have an example here. For example, a company A Limited has some slow moving inventory costing about, say, 1 lakh rupees, which they had already written down in the books of accounts to 80,000. However, subsequently, the company was able to realize 90,000 against that inventory by selling it to a part of reduced rate. The doubt here is whether the income of 10,000, the difference between the 80,000 and 90,000, should be recorded on the sale of written down inventory as per both AS and Ind AS, and also will there be any deferred tax impact on this treatment?
Okay. Yeah, ma'am, some numbers has come. Let me put down all the confirmation with the numbers that we have. Yeah, as you have told about the cost of the inventory was 1 lakh rupees.
Yeah. And they had written down it to 80,000 because of the slow moving
Okay.
inventory.
So from 1 lakh, they took it as 80,000 as a inventory.
But subsequently, they realized 90,000 against the
So
inventory.
they have made a write down of 20,000.
Yeah.
This was the original case, but now or subsequently, you want this 80,000, the value has increased to 90,000.
Yes, they've sold the inventory for 90,000.
They sold the inventory for 90,000.
Yeah.
So the question before us that now again there is an increase of 10,000
Right.
from
Now
the
the
earlier
question
value.
is where this 10,000 should be recorded.
Yes. So now this 10,000 will be recorded at what format? Like the standard is telling that any write down that you have done, that is previously you have done a write down of 20,000 and subsequently any increase is happening in the value of inventory, then you can reverse that write down. You can reverse that write down that you have already done in the past. But the maximum write down that you can do is maximum write up that you can do upward is to the extent of whatever you have already write down. Like for example here, for your 10,000, it will be written up, or you can say a reversal will be done from the write down. But this would be the maximum amount that you can write up. Like for example, if 80 you have sold it 90,000 in our case, but if you would have sold it at 1,20,000, for example, in this only 1,20,000, then the increase is happening is 40,000. Then you cannot reverse more than 20,000. You cannot reverse more than 20,000. So the reversal of the write down can be done at a later stage. If any increase is happening, that would be the maximum reversal that you can do. Balance will be considered as your income. I hope these numbers are properly placed, ma'am, according to your question.
No, absolutely. The numbers are properly placed. And yes,
I need to understand something out here. Because this may not be too much the awareness regarding this write down of inventories. So my just a simple for understanding that when we say that we value inventories at lower of cost and NRV, so when can this write down be done and what would be the accounting entry?
Yes, so this 20,000 which we have, that we have already charged at the time because we have reduced the inventory by 20,000. So that we have charged to our P&L account by default.
No, write down here, does it mean that we have valued the inventory not at cost but at NRV?
Yes, sir. Yes, sir.
So that when we value it at lower than the cost NRV, then that is called as a write down.
Yes.
So my next year opening balance would be that item only, 80,000 only.
Yeah.
Yes.
So next year when I sell it, there would be no inventory left.
Yes.
So that 40,000 will automatically go to P&L.
Yeah, it will come by way of P&L only, but that 10,000 is nothing but it would come by way of a reversal that you have done in the past. That 10,000 which we have in our example, this 10,000 would come by way of reversal because you have recorded the inventory at 80,000 at the opening stock.
No. Again, my two things.
Yeah.
I'm just talking from a general perspective. So when say for year ending March 23, I had acquired for during financial year 22-23, I purchased certain inventory for 1 lakh. At 31st March, the management was of the view that when I have to value at lower of cost and NRV, the NRV is 80,000. So I have to value it as NRV.
Sorry, sir,
So
I
it
would
was-
like to just add here. It's not because the management looked at the cost or NRV, it's because the inventory is slow moving in nature.
So even if it is slow moving in
Yeah.
nature, so when it is slow moving in nature, so to arrive at the write down, what Devas and Bhaveshji sir said, that when we are valuing it at lower of cost and NRV,
Right.
so
Yes.
it is valued at NRV.
Yes, it is valued at NRV because the trigger for this write down is cost or NRV, whichever is lower. And why NRV is lower? Because the inventory is slow moving. Because the moment
It could be other
inventory
reason
becomes
also.
slow moving,
It
yeah.
could be other reason also. The market has gone down for that product.
Yes, it could be other reason also. Yeah. But from the quotient perspective, yeah. Yes, sir.
So my only question, for understanding, so I had purchased of 1 lakh rupees. My 21st March 23, I value it at 80,000. So my 20,000 loss is automatically booked. I don't pass any entry in the books of accounts. Right? So next year, this my profit loss, 80,000 would be the opening stock. And I sell it for 90,000. So 10,000 is automatically booked as a profit in 23-24. Is my understanding correct, or it needs certain improvement?
No, that is right, actually, because it will be directly flowing in the P&L.
I will not have to pass any accounting entry for the same. Nah, I just wanted to ask.
Accounting entry, sir, it is not required, but that 10,000 has to be addressed. That it is not your, actually say it is your profit, but something which you have already, let it be in the last year also, it has automatically came 20,000. In the
Yeah.
current year also, that 10,000 is automatically is coming, but you
Yeah.
should show it separately as 10,000. That it is nothing, but it is a reversal which has happened of the write down that you have done in the previous year.
But sir, Bhaveshji, in my profit loss, 80,000 is opening, 90,000 is my sale price. How can I show extra 10,000 and extra? Because it is automatically my profit. So how should I reflect that when you say separately that 10,000? What should I reflect in my profit loss? Because 10,000 profit has come into my profit loss now.
Sir, can I just add one thing, if I'm allowed to?
I'm asking very practical thing.
Yes.
From the general perspective, not from the ASM index.
Yes. No, sir, that you are absolutely right, sir. See, the reversal of write down, or let's say again writing up of inventory, will happen in case the inventory we are still holding. For example, in the next year end again, this cost or NRV we will again do. Now, in that case, the NRV reaches to 90,000, right?
And we are still holding the inventory.
We are still holding the inventory, right? Now we are changing the facts, right? We are still holding the inventory. Now, in the previous year, we have taken a write down of 20,000. Now, in the current year, again, we will apply the same formula, cost or NRV, whichever is lower. Cost is 1 lakh still, NRV becomes 90,000. So now the revised inventory valuation becomes 90,000 compared to the 80,000 opening. So this 10,000 can come as a write up, or let's say reversal of the previous write down. In that,
so our understanding would be reversal of the write down, but the profit of 10,000 would be automatically booked.
Profit will be, it will flow into the P&L. So the moment you do the reversal of write down, it will come to the P&L. Yes,
automatically. The closing stock of inventory.
So automatically 10,000. The same thing happens for the securities also. Same thing happens for the securities only to the extent of cost. So just my understanding. Thank you very much.
Thank you.
Thank you, everyone, for taking up this question. Moving on to the next question, Divas sir. Again, an example. Suppose a company has reported short-term provisions, which include a provision towards old inventory, and the amount is significant, right? The same provision has been made part of the current liabilities part on the balance sheet. Now, is this disclosure in line with the accounting standards?
No, I feel because if let's say we are making any provision, or let's say we are carrying any provision on account of inventories, so the correct way to show it, or the correct classification for it, will be under the same heading of inventories. So ideally it is shown, let's say gross inventory less provision, and then the net inventory, and that net inventory is shown on the face of the balance sheet. So that would be the right classification and presentation.
Thank you so much, sir. And I would like to highlight this to the participants of this session, that this is one of a very, common mistake that happens in the financial statements, wherein an allowance or a provision for old inventory or obsolete inventory is created by the company, and it's shown as a provision on the current liabilities part, or as a separate short-term provision, which is not a correct disclosure. As Devasa mentioned, it should be shown as part of the inventory section on the balance sheet, which should be shown as a deduction from the gross value of inventory, just like we show the accounting receivables, right? We show AR, and then we deduct the allowance for bad debts, or provision for bad debts from this. Similar kind of a disclosure should be given for inventory and the provisions thereof. Thank you so much, sir. To the next question, how the expected cash discounts for prompt payment should be considered when determining the NRV of inventories?
Sure. So I'll be very honest. I have not actually faced, or I've never, exposed to the cash discounts adjustments to inventory. But still, since this was required to be discussed, so I tried to search over it. And to be very frank, because I am of the firm believer that if you want to learn something, then you teach, right? Because teaching is the best form of learning. So, this is a learning point for me as well. So because see, essentially in the entire India's regime, right, and the way we also think is, cash discounts are generally in the nature of financing element, right? Whether it is a financing cost for someone, or it is a financing income for someone, right? These are because you promptly pay, because let's say your regular credit terms is 30 days. Now, why you offer a cash discount? Because you are paying on the same day of purchase. That's why you get a discount. So essentially you are prepaying by 30 days, and hence you are incurring some extra cost on account of, or let's say extra income on account of paying it early, right? If you are a payer. So with that view, I always thought that, even cash discount should be seen as a finance cost or a finance income, and should not be adjusted to the inventory. But contrary to this, there was one IFRS implementation committee agenda discussion that I found, which specifically mentioned about this. What it mentioned is that cash discounts or settlement discounts specifically, because they call it as a settlement discount. Why settlement discount? Because the discount is being offered for settling early, right? So the settlement discount, they decided to deduct it from the value of inventory, from the cost of inventory, and and hence to show inventory net of that deduction. So with whatever things I could find, I would say that since in the cost, the IFRIC allowed to deduct the cost, to deduct the discount from the cost, hence I'm saying, taking an inference from there, we can also, reduce the cash discount from the NRV, because the question, it states that whether cash discount can be adjusted from the NRV or not. So the answer to that is yes, basis upon what, the IFRIC has discussed.
Right. Pramod sir, if you would like to add anything to it from the point of view of AS, because this we understand would be primarily to the companies applying Ind AS.
Regarding what specifically, Chandni?
Sir, cash discount. So if the company is giving cash discounts, in that case, how it should be treated as part of NRV? Will it impact the NRV or not? As Devas mentioned, the IFRIC says that it will be deducted from the cost of inventory.
Cash discount, to my understanding, is not on the basis of the purchase of an inventory. It is for the purpose of payment thereof.
Payment, absolutely.
So when it is for the purpose of payment, we don't reduce it from my inventory cost or my inventory holding also, because the same thing is applicable even for the turnover. If I say, unless it is inbuilt into my invoice itself. If it is inbuilt into invoice, yes, then it has to be reduced from my inventory holding also. But if it is not specifically into my invoice itself, then that cash, as per the ASI we talk about, it should not be reduced from the inventory.
So basically, for simplified, from a simplification point of view, I think, and or also from the most logical point of view, we feel that cash discounts, which are basically for prompt payments, as the mentioned, our settlement discounts should not be adjusted from the cost of inventory, because those are not part of inventory. It is given as a bonus for an early payment, right? It's a kind of a financing decision, and it's not related directly to the inventory and should not be adjusted to cost. However, as Divas sir mentioned, there is a guidance on IFRIC that these should be adjusted in the cost of inventories. Should be deducted as part of the cost of inventory. Right. I think for the companies, for participants who are dealing with companies which are applying AS, should keep it simple, can keep it simple and not adjust from the cost of inventories. However, the participants which are dealing with companies on Ind AS may look up to the IFRIC and study this guidance in detail and then apply to the situation basis the facts of the client.
Good. Thank you.
Thank you so much, sir. Thank you, Divas sir, for answering the question. Now moving on to Bhavesh sir. There's a manufacturing client which has various machine parts like spare parts, shafts, gears, bevel gears, pulleys, etc. And the client is not sure about whether these spares should be reported as inventory or PPE. Right? This part we also discussed in the definition, as part of definition, where there was some mention that this is mainly driven from Ind AS 16 when we talk about Ind AS and not from Ind AS 2. However, we'd request you to get into the details of this and discuss a few nuances on this.
Yes. Now, see, in this question, there is with inventory, we have used the word property, plant, and equipment also. Like whenever we are using this machine spare parts, shaft, gears, bearings, and etc., whatever it might be. So let me take one example for that. Like, see, if any company is having a service contract or an AMC contract, where their people are going to the client place and they might be providing the service over there. So they are going with some parts which they will be using to provide the service. And there would be another basket of parts which they will consume at a client place in order to provide the services. So let me divide the spare parts into two parts. Like some parts which they will consume during the process of providing the service, and the other parts which they will use in order to provide the service to the customer. So the first one which we have, like the consumption of those spare parts will be done at the client place. That I would like to take it as, or on the basis of the standard, the client place under the service contract as an inventory. But now we can't take a base of consumption, but let's take that consumption is not. But if I say, if those consumption may happen within a period of 1 year, let's take less than 1 year, all those parts will be consumed. We can treat that as an inventory. But those parts which you require in order to provide them the service, which we treat it as a property, plant, and equipment, because that would be used for a period more than 1 year. That would be used for a period of more than 1 year. So it is better to divide the parts into two parts with an less than 1 year. If any spare parts or whatever the parts which are being consumed, we may treat it as a part of inventory, and those spare parts which you are going to use in order to provide the service that generally has a life of more than 1 year, which we should carry as an property, plant and equipment. That would be the, I think, proper way to treat the spare parts where this kind of a manufacturing client that we have.
And the scenario, the treatment would be same for AS and Ind AS both, or there would be any difference?
Yeah, same.
Same would be there.
Yeah.
Okay. Thank you so much, sir. I think that clarifies the whole situation very well, that if the part is being consumed at the site, will be inventory. If it's not being consumed and you're reusing that for more than 1 year, will be a part of PP. So I think that's the most simplest way of explaining this. Thank you so much.
Yeah.
The next question, if at the time of physical verification, there is a discrepancy in the physical stock of inventory versus what is available in the system. I think we all can relate to this case in our experience of articleship or practice or employment. I think we have came across this situation in one or the other way. So in such a situation, what should be the course of action for the management and how such discrepancy should be dealt with in the books of accounts?
As you told about the practical experience, let me share my experience to this particular physical verification.
Sure.
Like we went for one of our client when I was doing articleship. That client was manufacturing tea, and they had that wooden box of tea was been stored in that, like comprises of 50 kg, 100 kgs. So I took one person and told him that count the total number of boxes which are there. So he counted and he brought the total numbers. We were with them, we multiplied, got the total kgs. But there were 1 or 2 boxes which were empty. Not that much empty, but something was there, but some tea was not inside the box. So I asked to the manager that where are those balanced kgs of tea which is supposed to be there in this box? He said, sir, wait, it is there in my office because I took it by way of an sample. So I was waiting for him. He has gone and he brought the balanced packets and he just filled up the box. But I show him where he has gone to take up this tea. He has gone somewhere little bit some far away so that I cannot see. He opened the other box. He took the tea packets and he showed it to me. So I told him that, what are you doing with me? I am an article. I am not your sir. But being as an auditor, how can you lie with me? Some packets of some kgs are missing would have escaped the materiality concept also. Then I explained him the materiality, that I would have ignored this even if you have not brought the boxes. So why you are worried about that? If some boxes itself were missing, then it would be a question before us. So here, your question, I hope it is getting matched with my experience which I told. So something is missing, but how much it is missing, that is also important. I might leave it by way of an materiality concept because it was a crores of rupees of tea was there. In that some 50 kgs or 100 kgs are missing. We ignore that by way of an materiality, number one. But second thing, in accounting, though, we are supposed to give an effect. If it is not coming, we'll find out the reason for that why this discrepancy has arisen. If that discrepancy is there, it would, if it is not available to trace, then it will become your abnormal loss, and that we are supposed to treat it in our books of accounts. And to that extent, we will reduce our inventory also by treating as an abnormal event which has happened. Looking towards the materiality concept also, with that we will give the disclosure if it is material in nature.
Right. Thank you so much, sir, for also that example. Definitely helped simplifying the question for the participants. So thank you so much. Moving on to the next question. I think we are now running out of time. To Divas, sir, there are various inventory valuation methods in the standard, such as FIFO, like weighted average, retail sale price. However, how the company should determine which one is best suitable for their type of inventory?
Sure. So I think some of these methods we have discussed during our discussion, right? What is actually FIFO, what is weighted average, what is retail sale price. So I will not go into what exactly they are and how it is there. But there is one thing which standard definitely does not allow is the LIFO method, right? So standard bars on using the LIFO method, which is the last in first out. So that is something that we should refrain from. Further,
Right. Sorry to interrupt. This is for both AS and INDES.
Sure. Okay. So as far as INDES is concerned, that is not allowed. Now let's come to FIFO. Okay. Now in case of FIFO method, which is first in first out, it can be assessed whether the inventories that the company is dealing into is really up to the date. Let's say the company is physically, following the batch system, and physically also they are following FIFO, right? Physically they are picking up the stock which is of the previous batch, and then they are selling that first, right? So in that case, FIFO will be more suitable. Then where the stocks are, let's say, very much interchangeably, they are being used. For example, there is a I can say a big container in which, let's say, there are certain goods, and again there are certain goods that are added, and their identity gets lost, and then certain goods are being sold from that. For example, oil in a pipeline, right? And through that pipeline, it is being served till, let's say, the customer's premises. For example, gas for that matter, right? Because then it will lose the identity, and hence they can be followed a weighted average principle. I'm just saying it's a thought, right? And in other cases also, the weighted average can equally apply. Lastly, the retail method, which is being used, is for the large retailers which are using the different items which are very high in quantity, but they have similar kind of a margin, so they can just simply adopt to the MRP less margins, as we were discussing, and in those cases the retail method would be more appropriate. So yeah, so this is something that I would like to answer for this specific question. Yeah.
Right. So are there any more types of any more methods of inventory valuation than FIFO, weighted average, and retail sale price? I think there's specific identification method.
Yes.
This.
So basically, if you see, these all three methods are for those inventories which are large in quantities, right, and which cannot be specifically identified. But before that, the standard also makes a very distinction that in case you are working on a specific project, or in case you are working on a specific contract, so any inventory billed for that contract will be identified as a specific cost project, and in that the allocation can happen. One thing I would like to say here, with from my practical experience again, I have seen the companies following different cost formulas, right? Let's say FIFO, weighted average, or retail sale price for different operating segments, right? It's not that at a company level you are following the similar thing for all the inventories that you have for all the operating segments. It's not like that. So even because it really depends on the nature and use of the inventory. If the nature and the use of the inventory is such that FIFO is suitable, so one operating segment will be following FIFO. The other operating segment will be following weighted average.
Right. So since you have mentioned this, is it in line with the accounting policy selection, which says that it should be consistent?
Yeah, I mean, see, from the consistent standpoint, if let's say in year 1, we are following for our operating segment A FIFO, in year 2 also, for the same operating segment, we should follow the same FIFO, right? And for the second operating segment, if you're following weighted average cost, in the second year also, it should be weighted. So consistent, the way I see is from the perspective of years of operations. And from different operating segments, why I'm saying it is consistent, because it is consistent with the nature and use of the inventory.
Right. So basically, just like we discuss in AS 16 and AS 10 again and again, the class of property, right?
Yes,
the class is
yes.
Very important to understand that it depends upon the nature and use of that particular item to the company.
Yes.
So if there are different classes of inventories, there can be different methods to the respective classes.
Right.
However, within that class, it should be consistently applied.
Right.
Yeah, in
Right.
that, ma'am, like that cost or NRV, that also we are discussing that that cost or NRV also would apply to the product to product. No, we can't merge four products and can take a total, and we can't take a NRV of the four product, and then a total to total would not be compared, but it would be compared product to product.
Item
So
by item.
in that sense also, like we need a different valuation for a different product if they are dissimilar in nature. If there are similarities there in the same group, we have four small type of product, then we can merge and follow the same method. But once that product is getting differed, then the principle will also apply to that line, similar, different line, different product, or a different industry also, in line with the cost or the NRV that we are applying.
Right, absolutely. Thank you so much, sir, for adding this. I think we've missed this in the discussion so far, and it was very important. Thank you so much for bringing that up. On to the next question, back to Divas, sir. Uh, in the annual report, a company has disclosed an accounting policy for inventories that values raw materials at monthly average purchase cost and finished goods at monthly average selling price. The rationale given is that the cost of individual wheat products derived from grinding cannot be separately determined, hence, the selling price basis is adopted. Is this approach adopted by the company comply with AS2 and from India's point of view as well?
Right. No, from both the point of view, as we have been discussing that, it should be at cost or NRV. So rightly following the selling price would not work. I mean, a rightful assessment of cost and NRV should happen even in case of in these cases. Now the question might come that if cost is not ascertainable, what we can do? Now the standard also says that there is something you can come up with a standard cost, right? Although it should be near to the actual, but in case, let's say, in case of following a standard cost, the company can come up with a bill of material, right? In which the company can think of putting all those specific inputs that goes into producing some level of quantity as an output. So if that is there, then tracking of the cost can become easier. But straight away following the monthly average selling price is something that is prohibited in both the standards.
Right. So it is imperative to follow the concept of lower of cost or NRV,
Yes.
whatever the case may be. And the appropriate disclosure should also be given. In case there is any impracticality in determining the NRV, we discuss the alternative approaches. If the estimated selling price cannot be determined easily, then they can be referred to the MRP of the similar product, and the margins can be adjusted accordingly, or the past trends of the MRPs can also be referred to. Right. So thank you so much, sir, for answering that question. To Bhavesh, sir, there is a practical question related to the disclosures. I'd like to share my screen and show a particular abstract of disclosure that a company has made in their annual report. And I would like to request you to discuss the nuances, if it's correct or not, and how the appropriate disclosure should be made. So this is basically the disclosure wherein the company has, can you see my screen?
Yes, ma'am.
Yes. So basically the company has disclosed capital work in progress revenue account under the note of other current assets. And the board viewed that this balance relates to the stock in progress and the asset is in the process of production for sale. So is this particular disclosure correct in your view?
Okay. Yeah, ma'am, like while disclosing the inventory in the financial statement, we need to see that first of all, inventory is classified under which head and in line with the reference to the standard. Like for that, we need to refer to the para 6 of Ind AS 2. Yes, ma'am. Now you have to stop sharing the screen. I would also like to share one screen. Okay. Yeah. Is my screen is visible, ma'am?
Yes, sir.
Yeah. So para 6 of Index 2 of inventory, they say that whenever it is your inventory, it has to be classified under these 3 points. Like you have inventories are your assets, which will be either A, B, or a C. That is either held for sale in the ordinary course of business, finished goods. Number 2, in the process of production for such sale, it will be your WIP. In the form of material or a supply to be consumed in the production process, then it will be your raw material. So generally, you will have finished goods, WIP, and raw material. All finished goods are meant for sale. WIP, we take it for the production, process of production, but it is for sale. And that raw material also we are consuming, that would be able to help us to get the manufacturing finished goods. So these are the 3 inventories that you can have in your financial statement as per para 6 of Index 2. But as you have shared the screen, it was showing that capital WIP and you have written revenue. So that would a little bit sound outside these 3 points, A, B, and C, which we have. So number 1, as you have shared the screen where it was showing as other current assets. As you have shared the screen, it was showing as other current asset, and under that, you would like to take up like capital WIP revenue. This would not be proper. This would not be the proper disclosure in line with para 6 of Index 2. It has to be shown as your work in progress. It has to be shown as work in progress. There is no need to be taken up like a capital WIP and revenue account. So this would not be the proper disclosure and presentation in the financial statement in line with your para 6 of Index 2. So again, I am repeating that it would be considered not as other current asset. It would be treated as an inventory and it will be classified as a work in process, because these are the disclosure specified, presentation specified under your Index 2 inventory para 6.
Sure. Thank you so much, sir. Yeah. Thank you so much, sir. So basically, for any stock in progress, any asset that is in process for production in sale, production for sale, it has to be disclosed as WIP and cannot be disclosed as capital work in progress, and should be a part of inventories, will not be a part of other current assets or other assets or any other line on the balance sheet.
Yes, correct, ma'am. Correct.
Thank you so much, sir. On to the next question. How is inventory valued at the time of dissolution of a firm or LLP? And is there any different treatment under ICDS? And is there any is the treatment same when the firm or LLP gets converted into a company? So there are 3 legs to the question. First is the inventory valuation at the time of dissolution of the firm or LLP, and also if the treatment is different under ICDS, and in case it's not a dissolution, it's a conversion into the company.
Yes, ma'am. Now ICDS has come into the picture, like for the income computation and the disclosure standard. Let us first enter into that part. Whenever we say a dissolution is happening, see, a dissolution will happen. That means there would be there is no confirmation is required about the going concern. Whenever you say dissolution, that means a going concern has shut down. That means a company is, a partnership firm is shut down. So even ICDS is also taking a base of NRV. Even ICS is also taking a base of net realizable value that we must consider under this kind of different constitution change which is happening, either by way of a dissolution or either by way of an conversion. So more of we are supposed to highlight in terms of the ICDS then it is valued at the net realizable value. But when you come down to the conversion, it would not be a question of going concern, because see, as and when you convert, that entity is going to continue. So at the time, they say that you must value at NRV under this different type of constitution change. But there would become a pause to a challenging point about that. There is no question of going concern about the conversion, but still they considered the valuation at net realizable value under this different type of change in the constitution which are happening. But again, I am repeating that at the time when you take a conversion, then there would be a case that somewhat a going concern would get lapped off during that particular situation. Otherwise, NRV would be the approach that will be followed. Over to you, ma'am.
Thank you so much, sir. Before I ask on any other important guidance, I would like to take on a few questions from the live audience. So one question that we have received from the audience is GST reconciliation on the closing stock with ITC balance in books of accounts. Guidance is needed as this is new area of dispute. So they are requesting you to guide on the GST reconciliation on closing stock with ITC balance.
So yeah, maybe I can add my thoughts. So essentially what happens, GST reconciliation is required to claim your ITC input tax credit, because the moment it gets reconciled on the portal, then only you will be eligible for the credit. Now, the question is very right, because in practically what we have seen is that, on the inventories that you purchase, you claim GST. And since at the time of purchase, you know that you are claiming GST, you don't add it to the cost of inventory because it's not part of the cost of the inventory. Now, later on, if due to some or the other factors, now again, I'm saying some or the other factors should be, what are they? It can depend on the situation to situation, right? Now, if due to those factors, we are not able to get our credit, hence that becomes a cost to the business, right? So the question is whether that cost can be added to the value of the inventory if it is still there in the inventory, or it should be charged to P&L, right? So I think that is the question. With that context, I would say, since you are denied of the input tax credit because of certain reasons which are not part of your initial purchase, right? Which can be, let's say, the counterparty has not paid the GST. That is why you are denied of that GST. That is point number one. Point number two, the counterparty would have erred in updating your GST details on the portal compared to what you should get, right? So to my mind, if we really see the underlying for not getting the GST benefit, it is not because of that you were not eligible for that, right? So hence it should be part of the regular operational cost, I would say. It can be part of the rates and taxes in the P&L. Maybe Bhavesh sir can add about his viewpoint, but yes, so as of now, I can think of this to the best of my understanding and knowledge. Yeah.
Yeah, this question is like, coming like for the particularly related to the 3CD that we are filling up for the tax audit purpose, like where also we need to reconcile the ITC balance that we have related to one of the close that we have. So that sometimes it happens that the goods are there, credit might be utilized, or it might be misutilized to some extent. So like recently, some 2-3 years back only, there is a revision has came into the 3CD point, 3CD that we have in one of these clause, that we are supposed to reconcile that entire ITC that we have related to the stocks lying at your place, related to the raw material or whatever you have consumed during your process. So that way, in that connection, would it make sense to take up this task. That is why this ITC balance with the stock is somewhat relevant for the income tax perspective also for the reconciliation.
Sure. Thank you so much, sir. Bhavesh, sir, they were both. We have just one more question from the participants we can take up. I think this is about the subsequent relevant information. They're asking how far is information received after balance sheet date relevant for inventory valuation?
Yes. So basically, again, we have to actually see two standards here, right? One is Ind AS 10 and second is Ind AS 2. So if I read about the paragraph 30 of Ind AS 2, it says that estimates of net realizable value are based on the most reliable evidence available at the time the estimates are made of the amount the inventories are expected to realize. The estimates take into consideration fluctuations of price or cost directly relating to the events occurring after the end of the period to the extent that such events confirm conditions existing at the end of the period. Okay. So to answer the question in this context, so if let's say certain conditions existed on the year end and later on they get confirmed before signing of the financials, then those needs to be adjusted in the valuation of inventory, which is NRV, because cost will not get impacted of that. If the condition did not existed on the balance sheet date and the event occurs after that, then if it is material, it can be taken up as per Ind AS 10, whether it needs to be disclosed at least as a matter of fact or not.
Yes, sir.
Right. So just to summarize from the point of view of inventory valuation, if we're talking about NRV, which is, I mean, we analyze NRV basis the conditions existing as on the 31st March, as on the reporting date. So post that, if the value changes, the estimated selling price changes, that becomes an adjusting event. Is that right?
If the conditions were existing on the date of the close of the financials, let's say, okay, let me give an example. Just a second. See, for example, there is a
just a scenario came to my mind. If say, for example, in April they sold the inventory at a particular price, then I think that's a short way of valuing it. We can adjust the NRV as on 31st March. Is it?
No. So see, specific to this question, let me take an example of a car supplier, right? Let's say some of the parts, there is a vendor who is manufacturing some of the parts and is supplying to a car manufacturer. Now, what happens at the year end, the vendor will have the inventories of those parts, and let's say they are carrying at the cost. But what happens after the year end, the car maker changed the models. Okay. And as a result, the part of the vendor became obsolete, right? Because now they will not be used by the vendor. Now, this has happened after the close of the financial, but before signing of the financials of the vendor. Now, in this case, if let's say the condition existed on the balance sheet date of the vendor that the car manufacturer is going to change the model, and hence the parts become obsolete, and hence your NRV will become very low.
Right.
And it confirmed later on. So then the impact can be taken in the NRV calculation as on the balance sheet date. But if there was no clue, it came out of a sudden and there was no market evidence that the car manufacturer is going to change the model, then this event need not be adjusted at least in the same financial year, is what I'm trying to say.
Right. I absolutely agree. For specific cases, such for specific conditions, for example, there may be a fire in the factory, right? Those all cases become non-adjusting because those did not exist as of the close of the financial year. And the case that Divas just mentioned is also one of the cases. If the conditions existed as at 31st March, it would have been an adjusting event, otherwise non-adjusting event. But say, for example, Very simple, and I think this will be most of the participants would be facing this situation. For example, an inventory is valued at 100 rupees as at 31st March, right? Basis the cost or NRV, whichever is lower concept. And in April, before the signing of financials, they sold the inventory at say 90 rupees, and 100 was their NRV. Right. So basically, they were already valuing it at the lower of their cost, lower than the cost, and now they sold at even lower, at 90. They sold. So should they revalue and adjust this cost to their 31st March inventory or not?
See, again, there need to be an evidence. Now, the evidence is clearly that it is at 90 rupees, right? Rather than the 100 rupees that has been taken earlier into the financials, it is being sold at 90 rupees. So to my mind, because the standard specifically says that the estimate of NRV are based on the most reliable evidence available at the time the estimates are made, right? So maybe we can, take these adjustments because these indicates that the actual NRV is lower, right? But in case of major events, right, which is, let's say, turning events, for example, the car manufacturer changed the model. In that case, those abnormal events, the conditions need to exist at the date of balance sheet.
Absolutely agree. Thank you so much, sir. I think the question has been answered to the participant. Now, we would like to conclude the session. Just anything else that the panelists would like to add on to it? Any other guidance which we may have missed asking? Is there anything that you would like to, impart knowledge on to the participants? Right. So maybe we can move on and conclude the session. Yeah. So on to Pramod sir for closing remarks and
thank you very much. Great. It was a great deliberation. So many issues discussed in a very interesting way, and making the discussion through a panel mode itself. Thank you, Bhavesh ji. Thank you, Devas ji. Thank you, Chandni ji. For giving your valuable inputs throughout the whole session. I'm very sure that all the participants would be enriched by such knowledgeable discussion today. Lot of concepts have been cleared today, so thanks to all three of you, and of course also thanks to Shalini and Kulashekara ji from the Institute for giving the all secretarial support to this program, and thanks to all participants who have joined today despite the 31st July due date being there for the ITRs. Thank you, everyone. Thank you very much.
Yeah.
Thank you so much.
Thank you for the opportunity. Thank you.
Thank you so much, sir. Thank you.